is the PowerPoint. And I don't know how familiar most of you are with the derivatives and credit default swap and all that. Should I?
Can you please make sure you're using
Oh, okay. Okay. Thank you. Okay. Well, I gave you this handout today. I got this from the Global Financial Crisis Analysis and Policy Implication, which done by the Congressional Research Service. It's really a picture that goes through the whole process, what's happened, okay? And then if you look at the beginning there, it will say 1997, 1998, the Asian financial crisis. And you will see when I go through the presentation, I'll be following this, okay? That's where you guys can see exactly what's happened every time, and you can see also the policy response there. Okay, should I go straight, or will we, after each section, we ask for a question?
You can do it whichever way you like.
Yeah.
Generally, it's lecture for the first hour, then questions, but you may take questions
Okay.
throughout
Okay.
if you wish for.
Anytime you have a question, please feel free to ask. How about that?
And again,
Break at 4. Okay. Now you all have a copy of this, is that right? Okay. Well, the global financial crisis, this is one of the biggest crises the world has seen in economics since the Great Depression. Every viable economic system must have both confidence and liquidity. And this is a crisis where we lost both. We lost the confidence, and also we lost liquidity. And we will talk about those two. In the US and in England, or in Europe, the crisis was mostly financial. In Asia and in some developing country, it was mostly about global trade, or losing the customer that they have here. Losing the customer they have here, basically. And that's a big difference there of how the crisis has been felt. After this crisis, a lot of things are going to have to change. The self-regulation of the financial institution will change. The role of the monetary policy will probably change. And also some fundamental thing may change here in the country. And maybe this country become an export country more than an import country. And that has implication for consumption and for saving, etc. Let's look at the origin of the crisis. The first part is a global saving glut. There's too much money out there in the last 20 years. And that started when you look at this here, you will see there 1997, 98, the Asian financial crisis, petrodollar accumulate overseas. Okay, you can see that's money that left when Thailand devalued currency, when the crisis started. A lot of people took their money out of Asia and started looking for a place to park it. And they came here. That's what started really this party. Asian and Middle East country start investing in the US. That will have implication on interest rate here. Then you can see here, this is the global saving gluts here. You can see the top here, this is the investment in the United States. These are the savings, okay? As you can see, the savings were lower than the investment. When that happened, either the interest rate have to go up, or you need to find somebody else to bring in money, okay? Now, that somebody happened to be emerging Asia. As you can see at this point here, the Asians start saving, China especially, start saving more than their investment. And if you can see here, the Middle Eastern country also, because of the petrodollars, start saving more. That money has to go somewhere because they don't have the absorption capacity in their country to have these investments. And that's where this money came here. Okay. Now, beside also this is what we call flight to safety. This is a place also to safely to invest your money. As you can see, that's the first part of that chart. That's one of the reasons why the interest rate remained low in this country, is because of this money coming from overseas. Now, the government also, or the Federal Reserve, eased the monetary policy because the Federal Reserve has two objectives. One is employment, full employment, and one is reduction of inflation. Okay? Why, we understand the full employment. Why do you think then we have the reduction of employment as one of the mandates of the Federal Reserve Bank?
Excuse me.
Yes.
We're going to try a lot with your mic, because when you turn away, we can't hear you in the back.
Okay.
So here's a lot with your mic for you. It'll be easier.
Oh, sorry about that.
Talk right into the mic.
Okay.
Click that,
Yes.
Flip that.
click that anywhere. I already turned it all on.
Okay.
I'll turn you up in the back.
What do I have to do? What is it?
Pardon me?
There's nothing we can do about the screen.
No.
Okay.
And then I put this.
Okay.
Sorry, excuse me. And you should be good to go. That way now you can go to the computer and
Okay.
still talk. And
Okay. Thank you. Okay. Can you hear me now? It's better? Okay. Well, I said the Fed has two months. Sorry. So the Fed has two mandates. One is full employment, and the other one is inflation. And we stay away from this. In this case here, as you can see, this is a federal fund rate. Federal fund rate is what bank charge each other for overnight reserve at the Federal Reserve Bank. Bank have to put reserve at the Federal Reserve Bank, but they can lend them to each other. Do I need to turn this down? Okay, and you can see here, these are the 2000, this go up and down depending on the Federal Reserve Bank, and you can see it went down here, 2003, 2004. In 2005, it started going up here. As you can see, level now it's very close to zero. It's 0.25%. Very low interest rate. But you can see over a long period of time, interest rate has been going down because of this saving saving level. You can see these are this line here is U.S. real interest rate over time going down, and then you have the UK rate. This is the Japanese rate, and this is the German rate. As you can see, over a long period of time, since the end of the 80s, the interest rate has been going up. Now, all of this prepare you for the housing crisis. All this is kind of the reason some of this thing happened. Now, there's also a deregulation that was going on at the same time. The Banking Act of 1933, it's called the Glass-Steagall Act, started the FDIC, but also put some rules on banks. Not saying the bank that take deposits cannot do. And over the year, those rules have been watered down until the 1999, the Groundbridge Act, which basically allow banks that take deposits to do all kinds of stuff. For example, Citicorp merged with Private Group. They have Salvador Brother in it. That was an investment bank. Smith Barney was brokerage. They have the Private, which has an insurance. As you can see, the bank now is no longer a bank in the traditional sense that it's take a deposit and make loan. The bank now is a full-fledged financial shop where you can buy stock, you can finance an IPO, initial public offering, you can buy insurance, and that's also will have implication. This is give you the money, buy the house, and then you keep paying. The loan will stay there. The problem with this loan is the bank would not sell them at the time because something called a prepayment problem. Prepayment means I borrow money from the bank at 12%, and the interest rate goes to 4%. I'm going to refinance. Is that right? Now, if they have sold the loan to an investor, that investor now have basically to go and put the money at 4%. You see, that's called the prepayment problem, basically, for the. Everybody understand that concept of prepayment, where if you prepay, you're paying the loan, now you are getting it 4%. That's why investor outside the bank didn't like this, because when interest rates are low, they get their money back. And when they try to invest it, they have to invest at 4%. You see, and that's why it has been always a problem trying to sell these mortgages, because of this prepayment problem. Came Salman Brothers in the 80s, and they said, let's pool these loans, okay, and sell them to investor. And we're going to put them in tranches in different prices. Now, we're going to pay a high interest rate for the people who are taking the most risk, people who get prepaid first, okay? And then we're going to divide this in different tranches. I was reading the Big Short, and he has a neat image there of the whole thing. He said, this is like if you are in a building and you are in a flood area, the first floor is basically the people who get prepaid first. They're taking more risk, okay? And then the second floor, the third floor, each one of them get a higher and lower interest rate, more risk, and do that. Now, they pull these loans, and they have some standard. They have to be of certain size. They have to follow some credit guideline, okay? A lot of people cannot, you have to have some credit standard in order for you to be part of this. And they are more or less also guaranteed by this government enterprise like Ginnie Mae and Fannie Mae and all these enterprises that came in and start guaranteeing this. This, Michael Lewis called this, don't make loan to people who can't pay them, but you can still make them, just don't keep them on your books. And that's what exactly happened in the 90s, is the bank, you borrow money from the bank sell your loan to somebody else, and they keep a service fee, a small service fee. And I'm going to go through a simple example that's going to show you how this process is done. This is what's happened in the past. $100,000 loan, and you are paying $742.50 a month for that loan. You go to your bank, borrow money, you get $100,000 to buy the house, and you pay $742.50 for 30 years. Then, this is the second model, where the bank starts selling your loan to somebody else. And you usually get a piece in the mail saying, Chase, this is now your bank. Is that right? Now, your local bank now is becoming a servicer of the loan. All they do is get your money and send it to, every month, take a small piece of it for the service. In this case, we are taking 0.5%. This is at 8.125% loan. We are taking 0.5, and they're going to send the 707.79 to the investors. Are you clear on this? Okay. It's basically your bank become a servicer. They will send you a notice. They will do this stuff, and for that, they receive a fee. But more important for the bank, they got money now from the investors, and they can lend more. And also, that loan is no longer on their books. All right? And that's another aspect of it that we'll see in a minute is very important to the bank, okay, in terms of how much they can loan. And then, more complicated. Everybody so far understand this logic here. Okay, then this is what's happened in the end. We start with the homeowner. Sometimes you have a mortgage broker, is a bank, and then these mortgage, they create called a special vehicle for this, where this entity, this legal entity, will buy all the mortgage and start selling bond on those mortgages. And a lot of more people are going to be involved in this. This is with the mortgage-backed security in. The rating agency going to rate the bonds. An insurance company going to insure. Investor going to buy them. Some investment bank will underwrite the whole thing. See, it's become an entity that's really now own these mortgages. Remember, we're doing it just one. Now we created a legal entity that will kind of take the whole thing and selling it to an investor. Now, all the money, this is what's happened. This is me and you, we're just going to funnel money now to this.
Question.
Yes?
Didn't all those agencies fail?
Did all?
Did they all fail, those agencies? The rating agencies failed to get it covered?
You are right.
Bond insurers
That's right.
way over their heads.
That's right.
The AIG.
That's right. You are right. All of these people fail to see where the problem is. And that's why it's end up costing you money. Is that right? But you are right. Everybody failed. And there's a lot of reason. Some economists talk about the incentive, the stuff that is going on with this rating agency and with his insurance company. And also the lack of understanding of the risk. You see, a lot of people thought when I put all these mortgages together, okay, I have diversification. Okay, and people said when diversification is high, the risk is low. But in reality, what's happened, when everybody defaults, there's no diversification. You see, I think those are some of the issues that people really didn't, this model they have done for this thing, they didn't take into account that a major crisis will kind of take away that diversification advantage that we have. Get this from a CDO Market Meltdown, which is a thesis by an undergraduate student at Harvard. She did really a good job at explaining the CDO market. And look at what's happened. These are the houses and the borrowers. These are the assets. It goes to this special purpose vehicle. And they're going to send money here. And you and I are going to keep paying the principal and interest to keep on. And you can see they divide it in tranches. Okay? Tranches mean, okay, well, you want the high risk part, the thing that gets prepaid first or get defaulted first, you're going to get you a higher rate. If they don't default, you are getting a higher rate. If they default, you're accepting the risk. And then we're going to move on here, okay, to the different type of, and they have different name for them to make it sound like mezzanine sound the way you look really good. But in reality, that's the second floor in the floodplain. Okay. Okay. They give it a lot of name. You know, when you look at the when we looked at the subprime, they don't call them mobile home. They call them manufacturing house, manufactured house. And they change a lot of the name to make them, you know, more like a good investment. Now, somebody asked me, what's this CDS or this credit default swap? Okay. Now, first of all, do we all understand this concept of CDO, which is a collateralized debt obligation? Collateralized means there is a collateral behind it. That collateral is a mortgage that you and I hold and send every month. Okay? And all we're doing is somebody figured out a way of selling our mortgages to somebody else and divide it in different type of risk. Okay.
What's a tranche?
Tranche, yeah. Tranche mean, you know, category. Yeah. It's a French word. Tranche is basically part. You see, this is a senior tranche. This is another tranche. They can have 10 of them. This is the mezzanine tranche. It's a junior tranche. And basically, there is a trustee for this special vehicle. And this is the vehicle that has been used in the in the 2000s. That's really fueled the housing boom, because banks now have more money to lend. Is that right? Because now they have access to bigger markets. Remember that glut we were talking about, all those investments? These CDO were sold in Germany to small banks. Because they got a AAA rating from the rating agency, they've been able to sell them all over the place. Even universities bought some of this stuff. Okay, now, everybody understand this concept of trying to sell the mortgage and get the money, sell more mortgage, and keep machine going? Okay. Now, come this concept of CDS. CDS is a credit default swap. It's not really a swap. It's like an insurance policy. And I'm going to explain that to you. GE has a $100 million bond that they borrowed, let's say, from the public or from a bank. Okay? GE every year send interest to the bank that took the money from. And at the end of the period, they also have to pay the principal. Okay. You and I are looking at it, and I think GE going to default. Sorry. And you think GE is not going to default. All right? I'm going to buy insurance from you. Okay? I'm going to pay you $200,000 every year. If a GE default, you give me the $100 million. If a GE doesn't default, you keep the money. Okay? Now, it's not an insurance because usually when you insure something, that means you have a stake in it. This, I don't have any stake in it. You and I are just betting that GE going to default.
It's a bet.
Well, it's not originally it was for hedging, and then it became speculation. Let me tell you what the hedging part is. I am the bank who loaned money to GE because GE is one of my clients. I want to keep them, but I'm afraid they are taking too much risk with $100 million. I'm going to go find somebody to insure it in case GE go. That's hedging part. Hedging means the bank were doing this for many years, trying to protect themselves. It's saying, okay, well, I just loaned GE $100 million, okay, and I want to just protect it by going to an insurance company and said, okay, well, I'm going to give you $200,000 a year for 10 years, but anytime GE default on that loan, you give me the money. That's the hedging part. Everybody understand that? Just a bank trying to protect itself. Because if GE default, the bank loaned them $100 million, the bank may get in trouble. Now came the people who speculate. The people who speculate has not given a loan to GE, has no business in this. What they're trying to see is trying to make money if a GE default. A lot of people, when they saw this CDO going and they saw all this subprime that we're going to talk about, they said, well, there's an opportunity here to make money. Let's see if we can find somebody to sell as insurance on this stuff. If this thing default, we're going to make money. And AIG was there to sell them the insurance because AIG and other people didn't think that none of this is going to happen. And they were just collecting the premium. Remember, if you are an insurance policy and these credit events don't happen, you're just collecting the premium. That's why AIGFP, which is a section of AIG, made them so much money over 5-10 years because they were just collecting premium, okay? Because nobody defaulted. Okay? That's called a credit default swap. There must be a reference asset. In this case, we were talking about the GE bond, or we can talk about the CDO. Okay? We can talk about anything. And the CDS buyer is the person who's paying a premium of $200,000 a year for 10 years. Okay? And the CDS seller, which is the insurance company, is saying, okay, well, give me the premium. If they default, I'm going to pay you. If they don't default, I keep the premium. That's called the credit default swap. The thing that's happened in this crisis is people now are doing it who have no link to GE or no link to the bond. They are just doing it betting basically on GE going under. Now, if you are a buyer, the CDS buyer, people who are buying the insurance, the maximum you will lose is the $200,000 a year for 10 years with $2 million. But if a GE default, you'll make $100,000, $100 million. Okay? Let's make sure we understand. That's the credit default swap. I mean, there's all variant of it that you don't need to know about, but this is basically the concept where people are insuring something they don't have a stake in. Okay? And they said, well, some people who saw early that the housing bubble going to burst start buying these CDS on this housing contract, on these housing CDOs. Okay? Is that clear? Yes?
So we went in and rescued AIG because they were holding all this junk.
That is
But
right.
what if we had not done that?
Well, some big bank will have gone under. Remember, when we started, we said two things are important, confidence and liquidity. If you have done that, some of these...
Repeat the question, please.
She's saying we bailed out AIG, all right? What's happened if we have not bailed out AIG? A lot of small bank, a lot of places will have defaulted, and that's what have created a high cost for the economy, because we said confidence and liquidity. That confidence will have deteriorated to the point where they will be run on the banks. And that's basically what the government didn't want to do. And there's all this notion of too big to fail concept that you probably heard about. In the 80s, Continental Bank, I think it's Chicago Bank, failed, and the government went in and rescued them. No other bank was failing at the time, but just the idea of making sure that people don't run on banks. That's part of that's problem. Now, the government let some bank fail. Lehman Brothers, for example, fail. Okay, and that's probably what started some of this. But I just want to make sure that you understand the credit event occur mean if people stop paying their loan or the bankruptcy or whatever is in the document there that say what it is. But that's what the credit default swap. Everybody? And yeah, yes.
So the buyer is the bank and the seller is the insurance company?
Historically, that has been the case. But the buyer today can be you or me or anybody. Okay? And historically, the bank who loaned money to GE want to make sure they're paying a small premium insurance policy. But in the last 10 years or so, this market has grown so fast. It's not just the bank doing it, it's all the investor. Any investor out there can buy a CDS or default swap. It's not just a bank. Any investor out there can do it. And they are traded in a lot of things. I can show you an example of that. I have... what do we need to do here? We want, okay, by name. And I want to just show you on, this is a credit default swap 2 days ago on Coca-Cola. Basically, they have a bond, and that bond is paying 6%. And it's going to expire in 2015, you can buy credit default swap on it, just like if you're buying a stock or buying something. Is that simple? Yes. Yes. Yes.
Yeah, as I understand it, on the part of default swaps, the issue really was, like with AIG and everybody else, is that the capital wasn't there to back it up. So when the private default swaps got called in, the way I understand it, the capital wasn't there, AIG and other people could not cover the losses coming out of these coming out of the mortgage market.
Yeah, that's true.
That to me was a big issue. So the government had to provide capital to AIG or the company go out of business.
That is right.
Whoever else.
Yeah, this place here, in the early days you don't need a collateral because the thing was going. And then people start insisting on collateral, okay? Telling, for example, AIG and all these places, where is the money if this happened? And most of these places didn't have it, didn't have the money, and the government has to go in and do it. Now, the process of taking your mortgage and selling it to other investment is called securitization. We are creating new securities. And we said the advantage of that is more money to lend, all right? And also it's free up the balance sheet of the bank. The bank doesn't have that alone on their balance sheet. It's gone because they created an SPV on the side that does this, and now the bank can loan money. Keep in mind that the bank can loan only a certain amount of money they have. They can't just go out and every time they get this money back, they can loan it, but they can't create money. Now, the other thing people thought about is the diversification part, where you are pulling all these loans from different area of the country and from different socioeconomic group. You could achieve a diversification, and we say that didn't work. The other one is this mispricing of risk that came out of this. Mispricing of risk is this. If I perceive the risk of those CDO are very high, I will insist on getting a higher interest rate. But because of the AAA that they put on them, and because everybody else was saying, no, don't worry about it. This is diversified. We have a loan from Ohio. We have a loan from this place, and nothing's going to happen. Okay? And that's one of the things that's happening, this mispricing risk. Look at what's happened to the home prices. This is the building cost here. This is the population, and this is interest rate. And look at what's happened to the housing because of all this securitization, because of these low interest rates, okay? And because of the deregulation. The housing price start rising. This is there is a good report there that you can look at in one of those resources called the Subprime Lending Crisis, which was done by the Joint Economic Committee of Congress. You can see here, look at California, look at Florida, look at Michigan. Here we are in Ohio. We didn't have really a big crisis here because our price never went that high, okay? But you can see Florida and California are really the place where Nevada also should be there. These are the places where the price went way up, all right? And that's where the contraction became also stronger in the end when this happened. These are the new home for sales, and this is a new home for supplies. And you see the imbalance that's what drove these prices. And because there's low interest rate, and we will see also because there's subprime now, a lot of people are allowed now to borrow money. Now, what fueled this is partly the subprime market. Subprime mean what? The prime market is when you go there, borrow money, they will ask you for income. All right. If you don't have an income, you can't borrow money. You can borrow from the bank. Is that right? The size of these mortgages, okay? The loan to value ratio. There's a lot of criteria. That's your score, credit score. If you don't qualify for this, we're going to give you a subprime loan. We're going to charge you a higher interest rate. Okay? Poor credit history, low or no down payments, elevated loan to value ratio. The value of the house is $100,000. Historically, you are looking at a deposit of 20,000, here the deposit is 0. Okay? High debt to income ratio, people who have a lot of credit card debts are now buying a house that is with no down payment. And also with a high loan to value ratio. Low documentation means sometimes these mortgage brokers didn't ask a lot of information about you. They didn't ask about your employment history. They didn't ask about your job, your income. And that's called low documentation. They call them, they have all kinds of names for them. They call them Alt-A loan. Alt-A means alternative to A. Alternative to A is, is no good. Yes?
Well, but everybody in the mortgage business knew that these loans were not worth a dime because they knew that the appraisals were all grossly inflated. You had a whole new business that came about, mortgage brokers. The only way they made money, and they made big money, was writing loans. So they went out and got appraisers who appraised the property at anywhere from 20 to 50% more than what they were worth. And they all knew that, and then they were reporting income for people, doubling their income where they had, and for some people had no income, writing in a fictitious income. All these loans were that way. It not only was on new homes, it was on resales, and even there was a whole vast market where the mortgage people were going out and telling people that had equity in their houses, grossly inflating their appraisal of their home and their equity, and issuing loans on that basis. So it's hard to understand why they could see it was total fraud from beginning to end by the whole mortgage business. And the banks that went along with it to write the money, and these people to make their money and make their commissions and write income. Total fraud from beginning to end.
You are right, everybody else, but also we, the public, who went to get those loans. You know, I mean, everybody has a share. I agree with you that a lot of this thing. This is true. Let me show you this. You are right. This is, look at this, 75% of subprime loan. And you are right, what you just said. 75% of subprime loan were made by mortgage companies that are weakly regulated. Okay? Keep that in mind. Those banks, the banks are regulated by state or federal government. These mortgage company or broker you were talking about were weakly regulated. Okay? Now, that's one reason this happened. From 1994 to 2005, because of this housing boom, the ownership rose from 64, home ownership in the country rose from 64 to 69%. And that's the highest rates in the industrialized world, people who own home. And that's part of this things. Shift from down payment to loan payments. When you see, that's also us, not just the mortgage. We also, the public also, 30 years ago, probably if you want to buy a house, you were saving for a down payment, right? In 2004, you don't need to save for a down payment. Just get the bank to loan you the down payment, okay? And most subprime loans are securitized via non-agency conduit. What does that mean? Agency means Ginnie Mae, Fannie Mae, because these type of loan could not be securitized through them, through Ginnie Mae, because they don't have documentation, they don't have credit history, they don't have that and that. They went through other processes. That's where the CDO were created, which has some of them. Okay, that's part of the broker and lender incentive work against borrower. That's what we were talking about. They were just selling them, all right, getting them off their books, selling them to a bank, and doing it. Again, there was some predatory lending practice in some area, and also they insisted on prepayment penalty. Let's look at a mortgage in 2005. You can see here, they will give you a 228. It's a fixed rate, very low rate for the next 2 years. Okay, that's called a 228. It's a 30 years long mortgage, but for the first 2 years, they give you this teaser rate, pay 3%. And then It's going to reset every 6 months after that based on LIBOR. Now what's going to happen is your interest rate is going to start at 2 or 3. Then when interest rates start going up, I showed you that graph, when interest rates start going up, then your loan payment, because they are variable, start going up. And that's where you default, because you can really afford it. You afford it 2%. Now, as long as the prices of home are rising, then you can sell the house. But when the prices start going down and you can't sell the house and you can't make the payment, what do? Walk out. And that's most of them did. You can have a 328 fixed rate for the first 3 years, 327. Finance professor cannot do the math here, huh? 327. And that's based on LIBOR. LIBOR is the London Interbank Offering Rate, which is an average rate in London, which is kind of the rate that most people use as a benchmark. These are called ARMs. ARMs mean adjustable rate mortgages. Okay? It has depended heavily on the price appreciation. As long as the price were appreciating, you can sell the house when the ARMs start going, when the rate go against you. And you can just refinance by reset. A lot of people said, okay, well, in 2 years it's going to reset. That means I'm going to start being charged a higher rate. If I can sell it after the reset, I'll make money. Okay. And this started in 1997. Between 1997 and 2000, some houses' price in some places have increased by 85%. Okay, then interest rates start to go up, all right? Increase in short-term interest rate. Housing prices are declining because it's a bubble. Bubble means the value of the assets. The price you are paying is higher than the value of the asset. Historically, you are not going to see these houses increasing by 85% every 5 years. That's just what's happened in the dot-com bubble. It's happened all the time when you have this bubble where everybody thinks that value is higher every time. And that's, there was the widening of all credit spread. I'll show you what's the widening credit spread mean. Let me show you that in a minute. You see, this is the difference between a BAA, well, let's take a AAA. This is the difference between a AAA rated. AAA mean what? Corporate. AAA mean very low risk, because the rating agency gives them AAA. That's the highest rate. And if you take the difference between that AAA and the Treasury for 10 years, you can see here that during this period, that spread has widened a lot. And that's the measure of risk. You see, when you see AAA paying 12% and the government is paying 8%, that's 4%. But when risk increases, AAA has to pay 15%, while the government is still paying 8%. That's called a spread. Okay? And you can see these are called widening spread in the market. This is a sign that really risk has gone way up. Is that right? When you see the risk has gone up, we know the government is not going to default. And we are charging them, that's 4%, let's say. Now, what we are afraid of is a AAA defaulting. Then we're going to charge them a higher rate. That differential in interest rate is called a spread. And it's a measure of risk. You can see it here. This is what's happened. Historically, look at it here. 2004, very small numbers. Now it went all the way here, up here. Okay? And it went down subsequently. This is as of 2 days ago. But you can see during the height of the crisis, really people were scared. And that's why they asking for a higher rate, even from the AAA. Okay? Because of that. That's called the widening of the spread. You can see it here for US BAA. Okay? And let's go back here, up here. Widening of the credit, and the freezing of much of the credit market. A lot of banks didn't want to loan money to other banks because they don't know if the other bank has too much of this stuff on its book. All right? And during a period there, after the Lehman Brothers collapse in 2008, between September and December, if you go to a bank, I went to my bank and talked to the teller and people like that and said there are a lot of people taking $100 bill out. They were taking their money out in $100 bills because they weren't sure if the liquidity was going to be a run on the bank. Okay, and that's the credit market froze. Nobody is lending anything to anybody because they don't know that somebody owe, and that's when that's happened. The decline in home equity loan and mortgage refinancing also. Okay, the bank stopped lending money, and the consumer spending went down. Now, consumer spending is around 60 to 70% of the economy. If everybody stopped going there, then factory had to shut down, and that's what started the whole recession. This is Bernanke here again. At one time, most mortgages were originated by depository institution and held on their balance sheet. Now he said they are bundled together into a mortgage-backed security, rated by credit agency, which they didn't do a good job, and then sold to investor. Okay? Since he's saying most of these investors did not perform any analysis because they rely on the AAA or the AA, led to a sharp decline in the willingness of investors to purchase this product. Liquidity dried up, price fell, and spread widened. Since July, few security backed by subprime has been issued. So that's exactly what's happened. You have liquidity dried up, nobody want to buy the stuff, the price went down, and the spread widened. Spread means the different security now are selling. Any questions, you guys?
Yeah.
Yes.
Can you quantify this? I understood that, there's about $10 trillion worth of mortgages at any one time, okay, in the United States. I understood that this whole issue was affected like $60 trillion worth of volume, all these loans and investments and all that. What I'm trying to understand is how much, really, can you quantify that? What really drove all that? Was it just the subprime market?
Small.
So, are you talking 5% of all loans, or 2%, or what?
You are right. What drove it is the prime market, which is a small part of the whole thing. But remember, we talked about confidence and liquidity. Even though it's a small part of it, and you are right, it's a small part out of the whole mortgage business. This is a small part. Some people, you see in all different studies, you see different numbers, but everybody think it's a small part. But that's a trigger. That trigger. Yes, that's the trigger. This whole thing, the trigger, it is this subprime thing, even though it's a smaller in the scheme of things in terms of the mortgage thing. Now, this is the rate of foreclosure as a percentage of total loan. All these blue things come from Bloomberg. Okay, just want to make sure if you don't see it, it's just the source is Bloomberg. As you can see here, we are going from 1995, going along, the foreclosure went up a little bit here. This is when the stock market went down, when the .com burst, where people didn't feel that they are rich anymore. Okay, and then you can see here, it started in 2006, 7, and the default rate right now is somewhere here, 4.5%. 4.5%. As you can see, this is really what's going on in the crisis is foreclosure as a percentage of total loans. This is called the VIX index, or called the fear index in the stock market. It's an option-based thing, and this has been very low all these years since 2002, and there is this hype here, okay? Big spike. And again, this is at the same time when all this was happening, okay? And that's what drove the stock price down. As you can see here, these are the yield we're talking about, the spread. These are the AAA. This is the Standard & Poor's 500, which is more or less a measure of the stock market. Sharp decline during this period. And then it went up a little bit. It went down since August, and then it's up again. I mean, but as you can see here, this is the 2000 bubble. This is like the .com bubble, and went up and then a run, and then this is the 2007, 2008 crisis. It went down, and it has a big run in it. How does this compare to? Let me show you an example here of this. I took this from a website called the dshore.com. This is the Great Depression. This is the 1929. The markets, the bottom is 89 minus 89.2%. Okay? Now, the blue line is 2007, 2009. It bottomed at minus 56.8%. And it has been going up. It went down a little bit, it's now up. Now, this one here, the green one is the dot-com bubble, the 2000, 2002. It went to 49%. Okay. And this is the oil shock in 1973. It went down by 48.2%. That just give you an idea. And here on this side here, it gives you how many months it took for that to happen. For example, this started here. It took 18 months for this to drop to 56%, minus 56.8%. Okay. And that just gives you a perspective of what's happening. I'll show you later on that stock market always come back. Okay.
This could be perhaps a good time for 5 minutes.
Okay. 5 minutes break. Thank you.